All right, we are live. This is your OZ Sherpa, Ashley Tyson, and I'm here with Justin Draplin today from Fortified Solar, and super fired up about talking about solar tax benefits and the one big beautiful bill. And what the one big beautiful bill, I'm going to refer to it from now on as OB3, or maybe O to the 3 to the B. Say that 5 times fast. But it was really exciting that we got this passed on July 4th. We were extra excited because it gave us permanence on opportunity zones. But one of the kind of, I guess, adverse feedback things that happened there was that they certainly did restrict some of the solar incentives that were available under the Inflation Reduction Act. And so, based upon questions that we've gotten from our followers, from our clients, and from everybody else, we wanted to make sure that we had gone through it. And I was like, all right, who better than the man himself, Justin at Fortified Solar. So, Justin, welcome today. And we're really excited to hear about one big beautiful bill, what the effects are, what Fortified Solar is doing as it relates to that bill, and how our clients can still take advantage of one of, I think that opportunity zones are the most, powerful, legislatively created tax incentive program, like place-based tax incentive program ever created. But I think that the solar program combined with that makes them sing all the more. So take it away. Show us how our clients can still take advantage of solar, even with the one big beautiful bill, OB3, and what they need to know.
All right. Well, thanks for having me, Ashley. You seem cool until you realize that we're getting excited about tax mitigation strategies. And
Dude,
then you realize we're total dorks.
Total dorks, but it's okay. And you know what? If you're going to get excited about anything, why not get excited about saving money?
Yeah. Yeah. And I'm good with it, right? Like, to your point, the OB3, 2B, whatever you called it, was very good for opportunity zones, was very good for bonus depreciation.
Yes.
Which is actually part of a solar mitigation strategy. So there's elements that are good for solar. Mostly it was bad. And then it does depend on who you work with. And so we'll get into some of the nuances of that change. Ashley's going to be way better qualified for kind of crossing how these fit in combined with an OZ strategy. But I think the gist of it is you can use capital gains, defer the taxes on that, and then offset ordinary income, kind of. I'm oversimplifying it, perhaps.
I love it. I love it because it literally is one of the few things that are out there inside of the wonderful world of tax, abatement programs that you can use in order to offset ordinary income.
Yeah. And no, it's not, I want to throw the caveat out there. Like, you can't just go do that. Okay. Like,
correct.
There's more rules around it. There's active participation requirements. Like, don't go do a solar deal and claim it. Please, you'll be in court. Work with somebody that actually knows what they're doing. And hopefully that's us, or Ashley can point you to the right people. But there's a lot of people doing it wrong. I will leave it at that and not throw any names under the bus.
That's a good time for me to point out, while you pull up your screen, Justin, that this is not tax advice. This is not legal advice. Legal advice would involve you engaging me and sending me money. And so this is not legal advice. This is not tax advice. And you need to advise and consult your own tax experts, and certainly make sure that you do that before you implement anything. What we're going to do is we're going to give you some information, and then we're going to empower you to act upon that information. We'd love to talk with you further, and we'd love to show you how you can do this. But at the end of the day, you've got to make sure that it jives with who your tax mitigation folks are and your tax experts. So Justin, screen is yours. Have at it.
All right. So exciting.
Hey, you know what? That's just it, is it? I actually really do get fired up about this stuff.
No, I do.
Like, when I started dreaming about it, that's when I got a little concerned. But hey, you know what? If you do it all day, every day, then I guess you should be dreaming about it.
I had never been so excited to watch C-SPAN as when they were trying to pass the One Big Beautiful Bill. I cannot tell you how many hours of C-SPAN I watched and how many times I looked at the camera and thought it had frozen when it hadn't. They just weren't doing anything.
Literally, it was just stagnant.
Yep, it was like watching water boil, but it never actually boiled. Anyway, okay, so we're going to give you a quick overview of the big changes in the bill and kind of some of the strategies that exist to utilize using the bill. But first, I want to just give you a quick background of what we're talking about here. So the Inflation Reduction Act of 2022 was passed by all Democratic Congress. And what it did for renewable energy credits specifically was created a new program. As a general rule, those credits are in the 30 to 50% range. There are some rules that apply that could be lower, and there are some rules that apply that could make it higher, but really the majority are going to fall within the 30 to 50%, depending on the various adders that you have available to you. They are available for ordinary income, passive and active offsets, C corps, individuals. Again, there's just different structures that would be used, different participation requirements based on what you're trying to target. And then when it passed, they were originally scheduled to continue through 2032, and then they were going to step down after 2032. Gave the industry this nice long 10-year runway, which was great for the industry, right? You can plan thinking like, okay, well, we have 10 years of our plan to execute on it. But the industry calls it the solar coaster for a reason, because there's these ups and downs that just come that you don't expect. And this is kind of one of them, right? And it's been going on for 20 years. So the industry is going to be around. They're going to make it through this, and there's going to be another up and another down, and it's just going to keep going. But where are we at today? Today, we passed OB3. So as of July 4th, anything placed in service by the end of 2027 still qualifies for the credits as they were written for the Inflation Reduction Act. It just says, okay, as of the end of 2027, they're done. No sunsetting, so no gradual step downs. It's just a hard stop end of 2027. It also added some stricter requirements, which are called FEOC requirements. And so anything that does not start by the end of this year will start getting even stricter as far as what is required in a project. And I'll get into some more details here. So first, what is placed in service? So if it's got to be placed in service by the end of 2027, what exactly does that mean? That means it's built and generating electricity that is able to be used. It's that simple, right? Doesn't have to be interconnected, could be off grid.
Okay, that's a big one.
You just have to have access, right? You have to be able to use the power. And then there's, again, I don't want to go down the rabbit hole, but that's the easiest basic.
Come on, man. I love rabbit holes.
Oh, it's a.
I bet you could go on a gnarly one on that one.
Just because we're excited about this stuff, I'm going to assume most people aren't. They just really want to find out like how they can save.
They're like, bluff, bottom line up front. What's the deal? And I love it because, you actually do that. You're going to cycle through this stuff fast because these points are actually very relevant because it factors into how you structure your stuff. There
is. And there's a lot of nuance to this stuff that very frustrating because even a lot of people in the industry don't understand because they're used to doing a specific deal a specific way for the last 10 years. And that's the only kind of deal they've ever done. They have no idea why they're doing it. They have no idea where anything came from or why. They just know that A plus B equals C.
Yeah.
They ignore D through Z that are all able to be used in the equation. But anyway, I digress. Yeah, but there is an exemption. So in the OBBB.
But there's more.
But wait. So there is an exemption that is in the first within 12 months from the bill being signed into law. If you've started construction, you can basically follow the existing guidelines. So the existing tax credit laws that are in place. which could potentially allow you to place that in service beyond 2027, 2028, 2029, 2032, and still get the credit. Mind blown. How do I do that? And this is partly what the executive order Trump put out like a few days after, and what he promised the ultra conservatives, right, was kind of targeting these safe harbors. They still exist. They're codified into the law. So it's not like he can just erase them or make them go away. Their intent is to kind of button them up a little bit, make them a little bit harder to prove, I guess. Not even harder to prove. They just want to make sure you're legitimately doing it, right? Like that's the point. They don't, there's people, again, like I said, be careful who you work with because there's fraud in this space. Whenever you've got the government giving out free money, there are going to be shady characters that come to the surface that try to take advantage of that, right?
And wait, really?
I know. I mean,
imagine that.
For instance, you've got Ashley on right now.
No. Nice.
Sorry, that was below the belt. But you know, vet it with your CPA, vet it with your professionals. I've actually worked with Ashley for a few years. He's done my OZ stuff. So he is one of the few, even in the OZ space, there are guys that all they care about is you sending them 50 grand to set up their OZ. And then, you know, who knows what you get. Ashley's one of the guys that will actually stick with you, answer questions, talk to your CPA, talk to your attorney, and make sure you get it done right. So that's what you want, right? And we're here for that in the solar space. Our partners are, we have a bunch of tax advisors that actually are helping with place these deals for people who work with CPA, all that kind of stuff. But again, just know who you're working with. So what's the real urgency? So part of that is we have these 12 months, but what you have is that FEOC requirement I mentioned, which is foreign entity of concern provisions. And so what that is stricter requirements. And this is primarily going to kick in more strongly after the end of 2025, which is going to restrict ownership by these entities. So they're going to look more closely at any influence from any of these foreign entities of concern, including corporate structures, as well as parts and suppliers of material for those projects. So this includes China. So one of the reasons,
predominantly what this is focused on, like a foreign entity of concern would be like anything that's got ties to like the CCP, state-owned stuff, that kind of thing.
Yeah, it's a lot of that. It's kind of whoever the government decides they're gonna put on that list, right? But it's designated, you know, potential threats to national security type stuff, right? Russia's on there, Russia, China, but
or potentially bad actors too that might have in the past, you know, put together sham ones like this, I would imagine.
It's mostly based on countries, but there's also like the Chinese military can. There's these variants, but the big one in this law is China, right?
Sure.
China. So most of solar comes from China. That's just the reality of the industry. They kind of own the market, whether you're talking solar panels, inverters, or batteries. And so this administration has decided, I'm convinced that the primary reason they're targeting solar is because it's all coming from China and they want to hurt China. I'm just convinced of that because solar is good for our grid, is good for energy production and energy independence. The problem is we're feeding China. That's my opinion. There's nothing I can, you know, I just watch too much news perhaps, but that's the reality. Like that's why this is an issue, because everything comes from there.
Yeah, because if you think about it from a policy standpoint, solar makes sense relative to our energy needs because there's no other energy that is as fast to be able to get it up and running and producing electricity as solar. And it's available for smaller operators to be able to do smaller projects. You know, nuclear is great. You know, some of the other kind of bigger power projects and stuff like that they're trying to, you know, to hurry up. That's all well and good. But the problem is that we've got serious demands for energy right now that we can meet with solar. And so it's like, all right, I get it that we certainly don't want to be funding China. And I don't know, maybe it'll end up, you know, onshoring and doing some more where we'll get more manufacturers like you guys here. Because I think that that's actually one of the important things right? For you to distinguish
Mhm.
is to tell everybody about your background. What is Fortified
Yeah.
Solar, and why do you guys, and maybe that's in the context of your presentation, but that's certainly one of the things that I want to hit.
Yeah, and we'll definitely dive into that a little bit. But basically, we have a manufacturing facility in the U.S. in South Carolina, manufacturing a building integrated photovoltaic, the equivalent of basically a steel roof with solar integrated into it. And it basically, within the nuances of the laws, allows us to do some things that you can't with a regular panel. And I will get into that. But then we're also, domestic, so we are. Make it
Good
easy.
old US of A.
That, we manufacture in the US and we're doing energy independence, and this administration just like has been gut punching us left and right between the tariffs and the solar stuff. It's like US made energy independence, and like you're picking on me. So that's okay. We'll be fine.
Unintended consequences, right?
That's right. I mean, it is what it is. We'll roll with it. Could have been worse. Could have been a lot better, but it
Sure.
could have been worse. And we've got solutions, which is the important thing, right?
That's right.
So that's kind of the urgency, is like getting stuff locked up by the end of this year, right?
Okay.
So how do we do that? We got to start construction by the end of the year. There are two ways to start construction. Number one, physical work of a significant nature test. And these are very, very specific. IRS has given guidance on this. You have to meet the rules for this. You can't just pretend like you started. Like, there is very specific guidance on this, which again goes to making sure you have the importance of the people you're working with know what they're talking about. There's two types of physical work of a significant nature. There's on-site and off-site. On-site is going to be you are installing the project, physically installing the project, not you have materials sitting in a pile. Okay. Like physically putting stuff up. That's your on-site test, right? Your off-site test would be manufacturing of significant project-specific items. I probably could have worded that better. But basically what that is you have to have something being built that's only being built specifically for your project. It
That's right.
cannot be a product that is of normal inventory, like a traditional solar panel. And this is, again, where our panel comes into play. We're custom built per project, which helps us meet that off-site physical work of a significant nature test that you just can't do with a regular panel. So let's get into that a little bit more. Again, physical work. What doesn't count? Everything that's not physical work. That's the clear answer. To clarify further, planning, design, permitting doesn't count, doesn't matter. You have a permit in hand, don't care, you didn't start. Financing or feasibility studies, all that's done, doesn't matter, you didn't start. I have all my inventory. I have every single panel, every single inverter, all the wires in my factory right now. Doesn't matter, you did not start. I have all the contracts signed, everything's ready to go. It doesn't matter, you didn't start. So this is the importance of the safe harbor, right? Like, there's the law is you have to have started physical work of a significant nature, and it's very clearly defined. None of this counts. So if anybody says, oh, we did all this work, we're safe harbored, I do a little more due diligence. Like, show me the proof. And I've had to do this with people, and when you do, they don't have the proof. They just want to talk. They want to talk their way into having met the test, but they haven't. So additionally, you can prove that you started construction. Well, when do you have to place it in service? You must show, with this specific test, remember we're still on one of two, you must show continuous progress. So you have to show that you're continuing to make progress on that construction. So again, if you think of a 2,000 acre or 3,000 acre utility scale solar project, you can imagine it's kind of a lot of
Take a
solar.
while to get done.
Yep. So this was a lot of the pushback on the bill, was like, some of these projects, you can start in the next 12 months. They will not be done by the end of 2027. Not
Yep.
physically possible with how much work is done with grading and land work and running wire. Like, it's a lot, right? Now there is a safe harbor, so you don't have to show, like physically prove the continuous work if you place it in service within 4 years. So as long as we've showed that we started construction, we really don't have to show anything until, in this case, it'd be 4 years from when you've started, right? So if we start this month, it was July, we have till July 2030, right? Magically, we've escaped the 2027 deadline, or 2029. So we've escaped the 2027 deadline by starting that project now. That's a very important aspect of these safe harbor provisions. Again, that is partly what Trump is trying to make tighter, right? But we're still within the existing safe harbor rules. So this is also plays into the urgency of doing it, right? Like they can change the rules again. But as a general rule, if we follow the law today and meet the safe harbor today, when they change the guidance in the future, we've met our safe harbor requirement when the law stood as it was the day that we did it. Should be good. Again, work with professionals, know who you're working with. I feel like I'm going to repeat myself a little bit here. There are delays allowed for permits, weather, supply chain, even within that 4-year window. And you can potentially place that solar facility in service through the end of 2032, because the existing law allows for that to be placed in service in 2032 and still qualify for the full credit. Again, this is primarily used for utility scale projects. And the piece that they primarily use to do this is a custom transformer. So if you can imagine these large solar facilities, they need a transformer to basically gather all of that energy and feed it to the grid or whatever they're going to do with it. And the reason they're built custom per project is because there's to stock an inventory of inverters that large or transformers that large, like they're hundreds of thousands of dollars, potentially millions.
Well, and they're also, I mean, I think that they're custom, right?
And they're right. And they're very, very specific. So nobody's going to inventory all of these options because a 2,000 acre one probably needs a different size transformer than a 2,020 acre one, which needs a different transformer than a 2,040 acre one, right? I'm kind of oversimplifying just to make the point, like that is where this really falls in as far as primarily meeting that continuous construction safe harbor. You've started your inverter, it's being built, might take 1.5 years to build, to be honest, or longer. So you started the construction of that project using the physical work. Number 2, 5% cash safe harbor. This is going to be, so we got the physical work test, right? Physical work of significant. This is the other one. This is the 5% cash. Regardless of where you're at in the project, if you have spent 5% cash of the qualified solar basis, you've met the safe harboring. So the IRS will look at that and say, okay, you've started. And that 5% cash could be spent on any piece of the project. There's not a requirement along those lines. The requirement is just the cash. Now you can imagine if you're not expecting a project to go in service for another 5 to 7 years, that 5% cash due today is a significant expense because there's a lot of risk between now and 4 to 7 years from now. So you need some security as far as being able to put that in service. But a lot of people are doing it, right? Who's your team you're working with? Do you have project pipeline? Is it an experienced developer that has executed and you have a reasonable likelihood of they're going to continue to execute? Caveat to that, qualified debt can count. So it says it's a cash safe harbor, but technically you could borrow to meet that cash.
Well, that's good.
But it has to be spent, and it's on the purchase price, not the costs, not the hard costs. It's actually on the, call it the retail purchase price of the solar facility.
Okay.
And then this one is called a continuous efforts. And technically you can use either one for either test, but continuous effort is not physical work, right? Continuous effort is just showing that you are signing additional contracts through this process to line up additional material, making additional payments, progress payments on that safe harbor project. And again, same other rules apply. Within 4 years, you don't have to show additional payments or additional effort, as long as it's placed in service with 4 years. Most people will, again, because if you miss it by 4 years in a month, technically you've missed it. You might lose your whole credit. So it's important to follow the rule of the law and the intent, and have backups, right? Check your boxes. There are some instances where delays are allowed. Permits, weather, same as before, same thing, following current law. And then this is going to be primarily used for people that have cash available, right? Generally, you're not going to borrow and then use that for 5 years, because now you're paying interest on that. But a developer that has the cash available and really wants to safe harbor a lot of projects, 5% cash really isn't that much considering the value of the credits, right? You're talking potentially a 50% credit on a $10 million project, and you only have to put up 500 grand. 500,000 to save 5 million is probably a good deal, right?
I like that math.
Right. That maths.
Yep.
Some other caveats. So project transfer. So even though a project has been safe harbored, it's allowed to now have a different owner, and the safe harbor goes with it. So you're working with a buyer, they've started the project, you've safe harbored it, you've shown that you've started construction. They can actually sell that project to somebody else, and that other person will now get the safe harbor. It follows the project, not the person. So that's important. Again, you want your attorneys to make sure the contracts are buttoned up in your due diligence, but that's important for being able to transfer that unit. The buyer that owns the asset at the PIS date, placed in service date, is the one that gets the credit. And that's when, holding periods kick in and all that kind of stuff. But up until it's placed in service, it's like hot potato, right? Who's going to take it next, right? But whenever it's placed in service, you're done playing the game. It's over.
It's all about having a chair when the music stops.
Yeah, there you go. Again, loose
How come
parts.
they never play those games anymore, man? Like, nobody plays hot potato. Or
because we're in our 40s and we'll get hurt.
Yeah, well, I guess even with the musical chairs, that could end up poorly too.
The only thing I'll play with kids is Duck, Duck, Goose. And the reason I'll play that with them is because generally I can beat them. And so it just feels good. But
I don't know, getting up from a sitting position and running are not my friends these days.
That's fair. Their reactions are so slow because they're going to sit in their Indian style and, anyway. So loose parts, inventory, that stuff doesn't count. That can all be transferred prior to being placed in service, still meet your safe harboring, all that kind of stuff. Super, super cool. The important element of this, contracts matter. Everything must be binding and enforceable. And again, the IRS has issued guidance on all this stuff. Like a CPA can double check this work, and these will be referenced in legal opinions, CPA opinions, and all that kind of stuff. But it must be binding and enforceable. Master contracts with project contract structures are acceptable, meaning one contract that covers a bunch of projects, and you can transfer out project level stuff, but still keep the master contract. Non-cancelable without cause, must be project specific, and there must be a timeline. There's some other rules, but again, you're working with an attorney, CPA, to make sure you meet those requirements.
So Jake's saying that he appreciates you making this easier. It's not easy to understand, but certainly easier. And trust me, from reading the bill to what Justin's putting together, man, it is night and day. So definitely appreciate you putting this together in a way that people can understand, Justin.
Reading the bill is not fun.
Not at all.
Part of the problem with law is it references other law. So they tend to not repeat themselves.
Yep.
So instead of repeating themselves to make it clear where you're reading it, it references another thing, which is fine. Go check that other thing. Well, that other thing might reference two other things.
Yep.
So you end up going down a rabbit hole, and you have to tie it all back together to so now
you got to remember what you were talking about in the first place.
Right. So again, please have professionals.
We had to do that with the OZ legislation, and we actually went back, and I think that the same thing happened with the solar, is that they modified the IRA. And so you got to go back, and what we did is we went back to the original legislation and then redlined it based upon what the changes were. And so you could actually see it all in one place. And that's the only way that you could potentially understand it. But yeah, so thank you for putting this together, because like the IRA part of it, if you're not used to operating in that space, like going back through the labyrinthine, different references and sub references and that kind of thing can be a bear. So thanks.
Yeah, for sure. It does look like we're getting some questions. I'll finish up here and then I will come back and answer some of these questions.
Perfect.
So what we're doing for our clients right now, we are locking in that eligibility. So we do have a pipeline of projects. We're safe harboring projects, meaning we're starting construction as well as using the cash safe harbor.
Okay.
Primarily focusing on like a 5-year window for our investors, because again, you lock into 5 years of project. You do year one, you get most of your cash back, but we've still locked you in for the next 4 years of projects. So you have that tax mitigation plan.
So you have that available for listeners here, for clients that are interested in purchasing these from you guys, that they could get in, do the first year, and then be able to set it up so that they got 4 more years.
Yep. And so we'd use that structured contract, right?
Yeah.
There's a couple of ways to do it. And it doesn't have to be for 5 years, right? We could just say you want to just safe harbor 2 years, whatever it is that you think your tax liability will be. And this is where one of the questions is the carry back and carry forward rules come in. So I'll get into that and where that plays in.
Perfect.
And so again, we're starting physical work on projects, and also obviously with the safe harbor, protecting clients and partners from further law or guidance changes by using this safe harbor. So I think that was the last slide.
Look at that.
OZ Pros. So let me kind of, if you don't mind, you want me to just go through some of these questions?
Yeah, and I can pull them up. So which one do you want to hear? Crystals first?
Yeah, let's just go kind of in the order that I think.
Perfect.
Let's go with Crystal. She's right here. So detail on carry forward or carry back rules included. Solar is super exciting. So there's a 3-year look back on these. So with a lot of people, what we're doing is we're structuring the deal to maximize the depreciation for year one. So like basically like let's wipe out all of your income for this year, right? And use the credit to actually claw back cash for the last 3 years. Now I say we're helping. We're not the ones physically doing this work, right? Like you got to have a good CPA, a good tax advisor, and we can help connect you to those people. We're working with a lot of them that are doing that right now.
And we've been helping people with that as well.
Yeah. So just go to ozpros.com/solar. Submit your information. We won't spam you. We'll help you. Help us to help you. But that 3-year look back makes the year one deal very valuable. Yep.
And that's the reason why we are asking. So in our information, we need your name and your email, and then we need to know what state you're in, and then what your tax liability is for 25, 24, 23, and 22, because that then allows us to be able to model it out to show, okay, hey, you buy this amount of credits and you're going to be able to take down your liability for this year, but then go back to 22, eliminate that tax liability, and then carry it forward to 23 and 24. And then if you had excess, you could also carry it forward. I think it's 22 years, or is it longer than that?
Yeah. Yep. I generally tell people 20. I think it is 22, but anyway, if you're
going to use it way before then.
Right. We're basically structuring, use what you need today, because again, who knows what your liabilities are going to be in 20 years and the interest that you're paying. Just stay with your 3-year look back, stay in the current year, maybe look forward a little bit, but yes, you can go back 3 years and you can go forward up to 20. And on the look back, it's actually this year, the year that you claim it, you have to apply it to that year first, and then you go back 1 year at a time from that year. So that's how the look back works. Carry forward is, you continue to move it forward. So
now on the look back though, you have to go back and go to 22. So you have to go back 3 years, eliminate that tax liability, and then it goes to 23 and 24.
No, current year first.
Current year first, and then it goes back to 22.
I would confirm with your CPA. This is not tax advice. I believe it's actually
Sure.
the next previous year, and you work your way backwards the ladder from today. I believe.
We'll get that confirmed, but I think it's man, and it's funny is that I actually love it when there's disagreement because man, it makes me to go back and to dive into stuff to
No,
make
yeah,
sure.
and then you know it
And
better.
what's funny is that
Uh,
I will completely acknowledge when I am wrong.
well, and
Uh,
so the thing is, so and that's I haven't really focused on that as a
sure.
detail specifically because we do defer to the CPAs. But if you're
Yep.
going back 3 years, it really doesn't matter. Just bundle up to 3 years, and that's what it is,
That's
right?
right.
Um, so yeah, but to your point, it may affect how somebody looks at a deal. So by all means, make sure you know what you're going back towards to use that. And then the depreciation is carried forward as well. You cannot take the depreciation backwards, but you
Correct.
can take it forward.
And you can take the tax credit, but that's so when we're talking about carryback, that's on the
Yep.
credit portion of it.
Mhm.
So give us the breakdown of that. So when somebody invests, like walk us through that transaction, what that looks like.
All right, now we're getting in the weeds. All right, so let's just say you have $100 project, and it qualifies for a 50% tax credit. Most of the ones that we do qualify for 50%. We meet the domestic content adder because we're a USA product, and we meet the domestic content requirements for a project. So you have a baseline of 30, you add 10% for domestic content. And then
Okay.
most of our projects right now are in energy communities, which is an additional 10% adder. So most of our projects will qualify for a 50% tax credit. So the way that works is that somebody that comes into one of those projects can basically take all of that depreciation in year one and can use that credit to, again, look back 3 years or carry forward. And so you've got on a $100 deal, you've got a $50 tax credit, which is a cash value that can be used to look back. And your depreciation available does have a reduction. So it isn't $100. That was our purchase. It is not $100 of depreciation. It's actually going to be $75 in this example, because you have to take 50% of your tax credit, which is 50%. Now we're going to start to get a little confusing. So you got to take 50% of 50%, which is 25%, and reduce your basis by that number. So that's how you
Correct.
get $100 minus 25%,
Yep.
half of the tax credit available to get your basis of 75. So that can all be the 75 deduction can be taken in year one, 50% tax credit year one, then 3-year look back. So that's the gist of it. There's some other levers. Generally on a deal, when somebody does a tax equity deal, they're going to get a year one ROI of 130 to 145%. So you're going to be net positive on your return as a general rule year one. Check with your CPAs, check with your professionals, make sure you're applying it. Every tax situation is different. Asterisk, asterisk, asterisk. I didn't tell you to do anything, right?
So what you're talking about is it basically, and when you say ROI, that's coming in the form of tax reduction, right?
Correct.
So you're not putting in $1 and then getting $1.30 back or $1.40 back from you. You're putting in $1, and then by doing so, you're going to be able to get the equivalent of around, $1.35 to $1. I've even seen it upwards as high of like $1.47, depending on what state you're in, relative to ultimate tax benefit that's going to come out. And that's going to be year one. And then you're going to have some residual benefits in the follow on years because of the depreciation and the revenue that you're going to be getting off of the project. So walk us through, inside of your projects too, right? That revenue piece, because it's a little bit different for your deals than other solar projects that are out there.
Yeah, I mean, tax equity as a whole it's all similar. There's a lot of different flavors, if you will. But as a general rule, you have to hold the project for 5 years because there's a recapture potential. But during that 5-year period, as you hold it, it's generating income. So thanks, Jerry.
Yeah, I would agree with that, right? That your explanation takes because it's hard to, I mean, some of this stuff is complicated, but
it is.
you've actually done a great job of distilling it down.
Yeah, thank you. I've had a couple ulcers trying to figure this out. So thank you. I try. So you got a little bit of cash flow, some sort of pref return on the cash that you put in over the next 5 years. It's pretty de minimis. It might end up netting 1% or less per year. But again, you already made 130, 145% year one. So then you just, stay in it for a few years. Sometimes in a long-term hold that ROI will go up. So your cash flow could potentially go up in a longer hold situation. All deal to deal specific, but there's also that tail of improvements.
And I think I know the answer, and I could probably hit this one, but the answer is no, David, is that, you buy it and then you use it. Well, I'm assuming so. Walk me through that, Justin.
Ashley.
I should stick in my lane. I'm going to stay in my lane. I'm going to answer the OZ questions and let you hit the solar ones.
Stick with opportunity zones. So these credits are transferable and sellable once. So what that means is whoever owns the facility when it's placed in service is the one that controls that credit. They can take it themselves. And then actually that can be sold or transferred by that entity. It must be done in the same tax year as it was placed in service. And you have until taxes are due for that tax year to make that transfer. Again, there's a whole process to that. You have to register it with the IRS. They give you a registration number. You use that number to make the transfer. But by and large, but as a whole, yes, they are absolutely transferable. Must be arm's length, unrelated party to transfer, for cash only. So there has to be a cash transacted specifically for the credit. Can't be used for anything else. But that cash is also non-taxable. It's an off-balance sheet transaction. So when you generate this credit potentially for $50 and sell it for $40, well, you've got to deduct all of that depreciation, and now you're pocketing $40 cash that is not taxable. So there's a lot of, again, that's why there's so many different structures. But yes, these credits are transferable.
That's actually interesting. And actually, I'm going to hit Matt first. He says, valuable info. Matt, thanks for being on today. And then John, this is a great question. Can this strategy be used to offset W-2?
Yeah, it is a good question. Yes. So again, you got to get very specific. There's what's called passive activity rules, section 469, I believe. I'm not a CPA. I only play one on Ashley's OZ Pros channel.
On TV, live TV at that.
Yes, there are structures that you can do this. You just have to be careful. There are very specific rules with how to do it. And that's where passive activity rules come in. And these passive activity rules are similar in real estate. There's levels of, you can do it with, this method is 100 hours. This method is 500 hours. This method is 750. And as long as you document that and prove that, and we actually have our own platform software specifically for that. So tracking the hours, so you have an auditable trail of the time you spent to make sure that you meet that requirement. So big picture, investment activity does not count. Leasing activity does not count. Now, that doesn't mean you can't treat it as an investment, and that doesn't mean you can't lease it. Okay, this is why the nuance is important. But the activity you spend to create the lease or to create the investment opportunity can count. Reviewing different opportunities, interviewing different solar providers, whether it's us or a panel manufacturer or whoever, that is all time spent because you're researching the industry, you're researching your opportunities. If you're just looking at a spreadsheet and plan to write a check and take your active participation, no, don't do that. Don't do that. I'm not a CPA. I'm not an attorney, but I am telling you point blank,
it's a bad idea.
And follow the rules. We can provide the legal memos and CPA memos from our attorneys and CPAs that say this is how you do it. You're going to review that. You're going to look at that with your CPA and your tax counsel. Generally, what we do to do a W-2 person is you got to start your own solar business. It is going to be a single member LLC that you fully own and fully control, in which case there's a 100-hour rule. You have to spend 100 hours on that solar business. And some of those activities can be attending this webinar and learning more about solar. That time can count towards your active participation. You can try to sell it to other people. Sales activities for solar would count as active participation. So there's lots of ways to do it. You just have to
Or
make sure.
researching how you could sell it, right? To your point that you could transfer them. And what, to your point as well, it could either be a single member LLC or you could own it through your QOF. You could own this through your qualified opportunity fund if it's in an opportunity zone.
Yep. And it's just, you might have different hour requirements applied to each, passive versus active. Again, there's a lot of nuance that goes into that. Short answer is yes. If so, how? Work with professionals.
Absolutely. All right. Amir asks a question. Could you offset solar tax credits for future deferred capital gains invested in OZ at the end of 2026? So what Amir's talking about is that everybody invested in an OZ is going to have a tax bill that comes due December 31st, 2026. And so he's questioning whether you could use a solar investment to offset that. And the answer is yes, Amir. And, this is one of the reasons why we're doing this is because we know that people are going to have that tax liability. So you would be able to, if you made an investment this year, you could carry forward depreciation. And depending on your active participation, your active versus passive, that could be used. But certainly the credits could also be used to the extent that you have carry forward or that you buy more in 2026. Justin, I don't know if you got anything else to add on that.
Buy tax credits.
Yeah. So Yvonne asks, can you somehow stack the benefits? And the answer is absolutely yes. And one of the great things about OZs is that there is no depreciation recapture on the back end. And so to the extent that you were to divest this after your fund turns 10 years old, you would not get hit with depreciation recapture. There's also other strategies that we can walk through relative to how long you keep it and what some of the potential exits are after that period, that kind of thing that could also be, of benefit relative to the getting out of the program too. We got a question from Stony. Is the window still open for 2024 tax liability? Man, I love all the input here.
Yeah. So yeah, right. There's a 3-year look back. So a couple ways to accomplish that. If there is, it depends what kind of tax liability you're talking about, active or passive income. Active would be you're past that window. You're not going to be able to get active because you weren't active in 2024. Okay. However, if you do create the solar business in 2025 and you get to be active in 2025, you can still roll that credit back and apply it to active income in 2024. That 3-year look back would apply to active income if you created active. And again, check with your CPAs, but we work with primarily Cherry Becker, which is a fairly well-known CPA firm. They have a specialty practice within there that focuses on these. And once that credit is created from active income, it is now active. So you can then look at back the 3 years and apply that to active. So the short answer is yes. Again, I gave you a longer answer. Additionally, if there is still transferable credits available, so if there's somebody that did a project in 2024 that is still has a transfer credit because you guys have both extended your tax extensions and haven't filed yet, if you haven't filed yet, then you can take that as a passive credit and apply that to your 2024 as well.
It's a good segue into this question. Right? Could a startup venture sell or liquidate the tax credits even if they had no previous tax returns?
Yeah, they're transferable, right? So if you enter into something that creates a solar project, then yes, you can sell that tax credit to an arm's length transaction for whatever agreed upon cash price that you agree to. And one thing I will point out as well, these tax credits are applicable to quarterly estimates. So with the intent to purchase them, that's the way the IRS says it. If you have the intent to purchase these credits or to do these projects, you can start applying it to your quarterly estimates. So again, that means in March, April, when you're getting ready to make your quarterly estimate, if you at that point intend to close on a deal by the end of the year, you can apply that credit to that quarterly estimate.
That's actually fascinating. Well, I intended to.
Yeah, you probably want to document that. Again, work with a professional.
Oh, man, that's hilarious. All right. So Carl's got a question about, and this is specifically as it relates to OB3 and the opportunity zones. Can investors roll their version 1 QOZ proceeds into a version 2 if the first QOZ1 cannot generate capital to pay taxes on April 15th, 2027? And the answer to that, Carl, is no. But wait, there's more. So if you let it roll to December 31st, 2026, that gain would not be eligible to be rolled into OZ 2.0. If you were to trip an inclusion event prior to December 31st, 2026, then yes, it could be rolled in. Once again, to Justin's point, it has nuances. So there's nuances relative to inclusion events and what that does to your ultimate tax benefits inside of OZ 1.0. So you got to be careful with it because you don't want to unwind all your benefits, and you got to be careful of step transactions and circular transactions. But yes, if you had an inclusion event, you could put it into OZ 2.0. We're working with the other experts in the field to kind of come up with strategies for that, specifically about how to do it. Stay tuned. Join our Ascent. We've got a weekly Ascent, OZ Ascent. You can go to ozpros.com and you can join that from ozpros.com. And we talk specifically about those types of issues and opportunity zone issues, including how you stack solar, how do you actually do the mechanics of that, how you buy it in your QOF, the specifics of it relative to active, passive, participation rules, that kind of thing. So would love to be able to help folks in there as well. I'm going to, I love this one right here. Eric says that even though the Emmys were just announced that we missed the cutoff, but man, we would have won had we been inside the cutoff. Eric, appreciate you being in here today. It's great hearing from you. I know that there's great things on the move inside of your where you work, and so looking forward to seeing how that rolls out. All right, we got one right here. The OZ window is still open for 24 capital gain, and yes, it is. Right, you could still get it in by September if you had it through a K1 or a 1099. So if it's coming to you on a K1 from an S corp or a partnership, then you could still roll that into a qualified opportunity fund. Arthur asks, what's the rationale for doing a project under the existing rules versus waiting for the new beautiful rules? I'm assuming that he's talking about OZs. Is there anything that would apply to that with solar, Justin?
Yeah. Why don't you answer it as an OZ? I'll answer it as a solar, and then we covered him no matter what.
Yeah, so I mean, we're definitely going to get regs, Arthur, on the OBBB, but we don't have those yet. I don't anticipate that they're going to substantially change anything as it relates to OZ 1.0. The thing about doing an investment in OZ 1.0 is that number one, you get your 10-year clock started. Number two, you know what the zones are. We don't have the new zones designated, and so we don't know if some of the better ones are going to be redesignated, and it's going to be a much tighter candidate pool for OZ 2.0. Justin, why don't you hit it on solar?
Yeah, so the rationale is safe harboring. So the rules are getting more difficult, especially by the end of the year when FEOC, foreign entities of concern, kicks in. That's going to be a big issue. As well as how many years of benefit do you want. So if you only want benefits for this year and next year, great, we can take care of that. If you want to lock in benefits for the next 5 years or so, that's where you're going to want to go, and get that stuff locked in by the end of the year, because you won't have to apply these stricter rules and the credits will still be available. So
awesome. This is actually a really good question. Could a new unexpected law derail all of these advantages and make the business structure obsolete? Well, I don't think that there's any chance. Well, I don't know. I'm going to wait to hear what you say, Justin.
So technically, The government can do whatever the heck they want. Right?
No Congress is bound, no future Congress is bound by what a previous Congress did,
Yeah.
as we see from this, right? Because they had the Inflation Reduction Act. We've got this sweeping bill that's coming in.
Yeah.
But once again, even when that happens, we see that right? Because there were a lot of people that wanted to completely they wanted to completely repeal the IRA, but they didn't do that. They tightened it up, but inside of that, it created opportunities for folks that are willing to, go and learn about it. So just curious about what you think on that, Justin.
Yeah. I'm not going to ever say anything's not possible because technically it is. And that's where making sure your contracts give you some outs, right? So, in our situation, right, if you contract for a deal that's going to be spread out over 5 years, one of those outs would be specifically if the law changes, right? Like if the law changes, you can get out of contracts, right?
Sure.
And so, but on the flip side of that, like as a general rule, for the most part, it just doesn't happen. They generally don't go backwards. Usually what will happen is here's the new guidance, and effective this date is the guidance, but anything that was in existence prior to that, you would still be allowed to follow. I think from a legal perspective, that has to do with something along the lines of like double jeopardy or something, right? Like you were following the law at the time and you claimed it as the law at the time. So when they do a retroactive law, like now all of a sudden you weren't following the law.
Sure.
I mean, you were at the time, right? So I think there's some legal
goes into takings and all that kind of stuff too. So yeah.
Yeah, right. So not a great answer, but
I get it. So Josh asked if the recording's going to be sent out. The great thing about this is that we are on LinkedIn Live, and it posts to LinkedIn, and it also posts to YouTube. So if you signed up, you're going to absolutely get access to the recording, and you can look at it at any time. All you got to do is just search it on YouTube, and it should, I think, automatically make it available on LinkedIn too. Stoney asks if I decide to put solar on my QZB properties, how would the project be classified and therefore receive credits?
That we might have to actually talk through that one, Ashley. I mean, the from a solar perspective, everything that I've said applies just fine. The basis will be generated for depreciation outside of probably the cash that was part of your QOF. I know a little bit about opportunity zones to be dangerous, but so there's some nuance maybe to what the qualified cash piece of that purchase would possibly affect the depreciation available. But credits can still be generated and dispersed and accounted for in similar ways.
Stoney, what's interesting is that one of the things that Justin didn't mention inside of his program is that one of the reasons why you're able to get the returns that you're able to get is because there's a fair amount of seller financing that's provided in the context of the deals. And
yes and no. We actually don't.
However, what is it? What do you call that? Financing?
For nuance. I'm a stickler for nuance.
Yes, and it's important.
There's a different. So seller financing is different than qualified financing company.
Sorry, I should have. In the context of it, but
yes,
you're exactly right.
So somebody could do seller financing, but there's also having a qualified financing company, and they're treated differently when these credits are calculated. So we actually do have a company that we have set up several years ago that can do qualified financing, which can be more flexible in terms and still generate the credit than seller financing. So it's a nuance, but I just want to be clear. So we actually have our own financing company that will help with making the projects successful for all parties.
Perfect. David asks, for these credits, is there any difference if these placed on residential versus commercial?
Yes and no. So the residential credit, which is a different credit than really what we've been talking about, we should have probably clarified. We've been talking about an ITC, Renewable Energy Investment Tax Credit. It's a business credit. There is also a 25D, which is a residential solar credit. The residential solar credit is terminated at the end of the year. So a homeowner that wants to install solar, that credit's going away. Now they can still benefit using that credit by a company basically buying the solar on their behalf and using the ITC for themselves. And that's where you see some of these lease structures.
Yep.
Again, it's going to look differently. There's still
Those are the guys that are out there knocking on your door. Hey, you want to put solar on your house?
Yeah. For the record, we do not do that. We
Yep.
do zero door to door. It's all commercial. We do not want to bug you. We're going to be doing some solar carports that you'll be able to see and have access to, but I promise you, we will never have somebody go door to door because they're just too annoying. It's just not worth it.
Nope. All right, final question. We are at the top of the hour. We're going to hit this last question. We're going to wrap this thing up. Muzio asks, does the safe harbor expire?
Yeah. So getting into this, once you're in the safe harbor, you're protected based on the laws at that time. So the law as passed said you have 12 months to start construction from the signing of the law. However, within that 12 months, the rules change, right? And that's where I said you want to do something before the end of the year first, because you start to deal with additional regulations, which would be FEOC. The other issue is the executive order that Trump put out last week, or on the 7th, I think it was, where he's saying like Treasury Department crack down and make these safe harbors more difficult. So technically the safe harbor is 12 months from when the law got signed, but the rules are changing as we go. And so the longer you wait, the more risk you're going to absorb.
All right. And I'm going to finish up with this one. Hey, look at me. That's somebody on my team posting. So once again, if you want to know and you want more information about this, you want to get connected with Justin, go to ozpros.com/solar, fill out the form. If you want us to get you a customized quote, fill out all of your tax information in your state, and we will make sure to get that over to you. We'll get you plugged in with Justin, and we'll get you in the process to be able to get you into the safe harbor so that way you can make this happen before this runs out. I think that's the takeaway that I got is, man, if you're thinking about doing solar, you got a tax liability, go ahead and get the ball rolling this year so that way you can get in line with Fortified so that way you can have tax credits and depreciation for 2026 available, and we can make that happen. Literally just submit the form. Justin, any final thoughts?
Don't pay taxes, please. I mean, legally, if you have to, pay them, but yes, try not to. Legally.
Absolutely. That is my mantra. I literally, right? So, I mean, that's the reason why I do what I do, is that I hate seeing people pay too much in tax. I'm all about helping people keep more of what they make, and in so doing, allow them and free them up to do well by doing good and to use those tax savings in order to do cool stuff that benefits your family, your environment, your community, and all of the people and the things that you care about. That's what tax savings is all about, or at least it is for me, and it is for our team at OZ Pros. So if you want to learn more about how to do that, how to do well by doing good, reach out to us at ozpros.com. If you want to get in the queue and get your solar going, fill out that form, and we'll make sure to get you plugged in with Justin and his team. This is a Sherpa wrapping this live episode up with the man, the solar man. I don't know. We're going to have to start.
I'm curtsying. You can't tell, but I'm curtsying right now.
There we go. There we go. Awesome. We'll see you guys next time.
Thanks, Ashley.
Yep. Sherpa out.